Right, welcome to the Canadian Slovenian Chamber of Commerce presents CSCC Business Insights 2022. I'm Sonia Rosenworth, the Chamber's Executive Director, and we invite you to connect with us as our members and associates present valuable business expertise and insights. We hope that these events will inform and inspire you as we navigate together through 2022 with hope and promise. Today, we're pleased to present Tax Secrets and Revelations with guest speaker, Mr. Tim Cestnick. Just move this over. Mr. Tim Cestnick, co-founder and CEO, Our Family Office, Inc., author of numerous financial books and publications, weekly Globe and Mail contributor, and CSCC board director. Tim's presentation will include practical tips on how your clients can maximize tax savings, and he'll share stories from his work as an advisor to Canada's most affluent families. We'll have a Q&A session at the end of the presentation where you're invited to participate, and we're happy to hear your questions or share any that you have posted on the chat. We'll conclude the event with Mr. John Doma, CSCC's president, and after the close, we ask you to complete a short survey about this event. This is our disclaimer. It will be posted on YouTube as well. Just let you quickly peruse it. And some brief housekeeping points for your information. Please stay muted so that we may hear our presenters. There will be an opportunity to participate at the end of the presentation during our question and answer session. You're invited to post your questions and comments in the chat throughout the presentation, and we'll address in the Q&A session, or you may wish to email us after the presentation as well at info@canslo.com. Note that we'll be recording today's event and posting on YouTube. The link will be shared on the canslo.com website, Facebook, and also emailed to our members and associates. We would prefer that you keep your cameras on, but you have the option to turn yours off. So right now, I'd like to take the opportunity of taking a gallery view of our participants. So please turn on your cameras if you're okay with it. Ready? Hair, makeup? Sorry, we don't have anybody to help us with that. Okay, done. Thank you. Thank you very much. So there's going to be a short survey also at the conclusion of this presentation. We ask that you share your comments and talk about future CSCC events that you might be interested in it. So allow me to introduce today's guest speaker. Tim Cestnick enjoys a reputation as one of Canada's most respected experts and public speakers in the area of tax and personal finance. Widely recognized for his in-depth knowledge, dynamic speaking style, common sense approach, and extensive national media exposure, Tim successfully combines business experience and professional credentials to advise some of the most successful families in the country. Tim is co-founder and CEO of Our Family Office, Inc., one of Canada's leading wealth advisory firms to affluent families. In 2021, Our Family Office, Inc. was named the best new multifamily office in North America by the International Family Wealth Awards. Tim's national speaking profile is confirmed by his position as a personal finance columnist for the Globe and Mail's Report on Business, Canada's national newspaper. As a prolific author, Tim has written several Canadian bestsellers: 101 Tax Secrets for Canadians, Winning the Tax Game, Winning the Estate Planning Game, and the Tax Freedom Zone. He has also authored Winning the Education Savings Game and co-authored Death and Taxes and Your Family's Money, among other titles, and is past editor of Tax Tips for Canadians for Dummies. In addition to print media, Tim is a regular contributor and on-air personality on radio and television. He appears regularly on CTV, CBC News World, BNN, and the best-known money programs in the country. Today, we are so pleased that he has joined us to present his tax secrets and revelations. Welcome, Tim.
Thanks, Sonia, and thank you everybody for taking the time to be here today. I just want to say before we start that it was last year that I joined the Canadian Slovenian Chamber of Commerce. It's allowing me to sort of get back to my Slovenian roots. My grandfather had moved to Canada from Slovenia. My family, my wife and I, my children, and my father went and visited Slovenia a few years ago for the first time and met some family over there. So it was a lot of fun, and I'm really enjoying being part of the Chamber of Commerce. So and just glad to be with you here today. And my number one goal for the next hour or so is to keep you all awake. If I can accomplish that, then that's a major feat, I think, by itself. So with that, though, I am going to share my screen, and just so you can sort of see some slides I want to share with you today. So here we go. Hopefully you can all see that. So today I want to share with you some tax ideas that we are using for some of our clients. There's also some ideas that over the course of time I've written about in the Globe and Mail, and some of these ideas I haven't written about anywhere. Some ideas are too good that you don't want to just share them too broadly, because then everyone will probably use them and then they could get shut down. So some of these ideas are a little more lesser known, but nonetheless, I hope you can get some value out of what we're going to talk about today. I want to talk about, first of all, what I call the pillars of tax planning, and then we're going to move into some very specific tax ideas for business owners, employees, families, investors, and retirees. And there's so much that can be said for each of these groups, but we can only pick or choose a couple of things to share with you for each of these types of groups. Hopefully you fall into one or more of these categories. I'm sure you probably do. So there should be something here for everybody, I think, in terms of tax ideas. But before we jump into the specific ideas, what would a tax presentation be without a top 10 list? So what I want to do first is walk through the top 10 list. For those of you who used to watch David Letterman, you'll remember his top 10 list every show. Today's top 10 list is, you know you're paying too much tax when. Okay, so the top 10 signs that you are definitely paying too much tax. So number 10, you know you're paying too much tax when T4 is relevant to you because it's your apartment number. Or number 9, you know you're paying too much tax when RRSP is what you did in response to that wedding invitation last month. Number 8, you know you're paying too much tax when you tried to deduct Starbucks as a workspace. Definitely doesn't work. You know you're paying too much tax when, number 7, you've been offered a job with the CRA and you tell them you'll take it if they pay you under the table. Definitely not a good idea. You know you're paying too much tax when, number 6, you choose to use cloth diapers instead of disposable diapers because you can save a few dollars of GST or HST. Number 5, you know you're paying too much tax when you pretend that you're a wounded veteran, your spouse is a volunteer firefighter, and your 8-year-old is a member of the clergy. Then you know you're paying too much tax. Number 4, you know you're paying too much tax when you turn yourself in for tax evasion in order to be paid the financial reward for whistleblowers. Number 3, you know you're paying too much tax when you're expecting yet another Christmas card from CRA this year. You know you're paying too much tax when, number 2, you've chosen to use the short form tax return, which only has 2 lines. Line number 1, income. Line number 2, send it in. That's the wrong tax form. And now, the number 1 sign that you're paying too much tax, identity theft is a problem, but the thief wanted nothing to do with your name or identity. There you go. That's the top 10 list for today. And that pretty much ends our presentation. So thank you for being here today. Okay, we'll continue with some other ideas. All right. I want to talk just for a second about the pillars of tax planning. Now, it almost doesn't matter where in the world you live. I know there may be some people here who are from Slovenia, or maybe even be in Slovenia right now. These pillars of tax planning apply anywhere. And really what I'm going to talk about here are 5 pillars that form the basis for paying less tax. So any idea you could ever come up with that's going to result in less tax being paid to the government is going to fall under one of these 5 pillars, if you will. So I just want to share with you what those are. So the first pillar of tax planning is deducting. When I talk about deducting, I'm talking about claiming tax deductions or tax credits to save tax. And you know, in Canada, there are lots of deductions, lots of credits. It gets confusing. We'll talk about some of them today. The second pillar of tax planning is deferring. Okay, deferring is the idea of taking a tax bill and pushing it from today to a future year. Now, you're still going to pay it, but you're going to pay it in the future. Now, why is that helpful? Because the money still sits in your pocket for that period of time until you pay it, and you can use the money in the meantime. You can actually grow, invest the money or do something else with it in the meantime. So deferring tax is still a valuable thing to do. The third pillar of tax planning is dividing. What we're talking about here is moving income from one family member who's going to pay tax at a higher rate to the hands of another family member who's going to pay tax at a lower rate. We call this sometimes income splitting. We'll be looking at a couple of ideas today on how to do this, but I'll use the term dividing here, but it's the same thing as income splitting. Number 4, fourth pillar, disguising. So what am I talking about here? I'm talking about converting from one type of income that may be taxed at a higher rate to another type of income that's going to be taxed at a lower rate. And there are ways to structure your affairs so that maybe instead of earning this type of income, you're earning that type of income. That's sort of disguising one type of income as another type. The last pillar of tax planning is dodging. Okay, I know this sounds illegal, but it's actually not illegal. What this is all about is structuring your affairs so certain amounts that you receive actually don't have to be reported on your tax return. They're not required to be reported on your tax return. I'm going to give you some examples later of this, but certain types of income are better than others because they may not be taxable. So these are the 5 pillars of tax planning, and all the ideas I'm going to talk about today will fall under one of these pillars or more of these. Okay, so I'll leave that with you, and let's jump into the next section I want to talk about. I'm going to talk to business owners for just a minute here, and then we'll move into some ideas for employees and others as well. But for those who are business owners, I want to talk about using a corporation for a minute, because you can carry on a business as an individual, or what we call a proprietorship, or you can carry it on as a corporation. Now, I want to show you some numbers here. You don't need to look at all these numbers on the page. Let me just share with you a couple of numbers to look at. On the top line, you'll see that here's an example where somebody earns $10,000 of active business income. So let's say in 2022, you earned some active business income because you're carrying on a business. Let's call it $10,000 worth. Now, I want to show you, if we jump to the bottom of this page, the difference between earning that $10,000 in your own name, personally, in your own personal hands, and earning it in a corporation, in a company. And in this particular example, with $10,000 of active business income in Canada, there is a difference between earning it in a corporation or personally. And the big difference is what we call a deferral of tax. You can see that at the bottom. So you see that bottom red box? It says deferral of tax, and it shows a number 4,133. What that's telling you is this, that if you earn $10,000 of business income and you earned it personally or you earned it in a corporation, you would come out ahead by earning it inside a corporation to the tune of $4,133, right? It's a tax deferral. Now, once you pay the amounts out of the company to yourself personally, either as salary or dividends, then the tax kind of catches up to you at that point, and you no longer have that benefit. But in the meantime, if you leave your profits in the corporation and use the profits inside that corporation, you're deferring taxes of over 41% in this example. That's pretty meaningful. So setting up a corporation to carry on a business, especially if you're earning active business income, makes a big difference. Now, if you're earning investment income instead of active business income, the tax deferral is not the same. It's very, very small, almost negligible, but earning active business income, a corporation does make a difference. So here comes the question then. Supposing you set up a company and you're generating business income, and you're saving this tax, you're deferring the tax, should you leave that money in the corporation forever? Well, I did mention there's a deferral, there's a benefit by leaving it in the company. But here's the problem with leaving it in the company. If somebody were to sue your business, maybe somebody slips and falls on your sidewalk at work, or maybe something happens with one of your products and somebody gets injured, or somebody sues you for whatever reason, any assets in your operating company, including that cash, that extra profit you've been accumulating, it's all up for grabs. It could be attacked by creditors. So we like to move it out of your operating company. We just don't want to put it in your own personal hands yet, because again, when you pull it out of the company, you pay tax on it, right? And we want to enjoy this 41% tax deferral. So what you could do is establish a holding company. So you could put a holding company between you and your operating business. So you own your holding company owns your operating company. You might still own shares in your own operating company as well, on top of that. And there's good reasons for that in Canada. We won't talk about it, get into the details of that today. But by doing this, now take that profit you've now earned on your business. What you can do is you can take it and take that excess profit and pay it from the operating company up to your holding company as a dividend. And intercompany dividends like this in Canada are not taxable. So you can move that money tax-free from the operating company up to your holding company. Okay, now I've simplified it a little bit here, the conversation, but that's generally how you would do that. And you can take out that excess earnings, if you will, park it in your holding company and not have to worry about that money now being subject to creditors or whatever. There are other ways to set up holding companies. You could do it this way, like the way I just showed you. You could also do it this way, where maybe you set up a family trust. You set up a holding company that is a beneficiary of your family trust, and then your family trust can own shares in your operating company. Now dividends can flow from your operating company up to your family trust and then out to your holding company from there. So that's another way to do it. I won't get into the details of why you might do one over the other, but just suffice it to say, having a holding company can make really good sense to allow you to continue this benefit of deferring the tax by keeping it in a company. Now, if you need the money to spend, you need salary or whatever, because you need to buy groceries or something else, by all means, take the money out of your company. But to the extent you can leave it in there, you're saving tax because it's lower tax rates than personally, generally speaking. Now, I want to talk about holding companies here for a second and the number of things you can do with them. Just really briefly, we talked about that deferral of tax, leaving the money in the company, keeping that 41% out of the government's hands. We talked about, we could talk about the lifetime capital gains exemption. If you have an active business and you're accumulating profits in that company, and that company's building up cash over time, you could throw that business or throw that company offside for something called the lifetime capital gains exemption. And we don't want to do that. In a perfect world, you want to keep yourself eligible to claim this lifetime capital gains exemption. Now, what is that? Basically, you can realize gains or profits on private company shares. So if you have a private company and the company grows in value over time, almost $1 million of gains can be sheltered from tax on those shares for each individual in Canada, each adult individual in Canada. So it's an important exemption to maintain, and your company can be offside and may not qualify for that exemption if it builds up too much cash. So by pulling the cash out of that company and parking it in a holding company, like I had suggested, you preserve that exemption. Holding companies are great to hold real estate. So if you've got an active operating business, maybe it's a manufacturing company or whatever it is, you've got your operating business over here, and then you've got the real estate that maybe you own the real estate that your business is operated on. Normally, you'd hold that real estate in a separate company, separate holding company, to separate it from the active operations of the business. Again, for asset protection or creditor protection, it's a good thing to do. If you're going to buy life insurance, it's quite often cheaper to buy life insurance inside a corporation than it is to buy it personally. So sometimes there could make good sense to use a company for that. You can also simplify your taxes at the time you die. In Canada, when you pass away, if you die as a resident of Canada for tax purposes, you're going to be deemed to have sold almost everything you own. There are some exceptions, but most things you're deemed to have sold. And so if anything has gone up in value, you could pay tax in the year of your death. Well, if you own a lot of different assets, that can be pretty complicated to figure out the tax bill on each asset. If you own your assets inside a corporation, a holding company, then you die, you're deemed to have sold one thing. that's your shares in your holding company. So holding assets inside a corporation can be a neat and tidy, an easier way to plan for taxes when you pass away in some cases. Corporations also offer limited liability. We've talked about, creditor protection. If somebody were to sue you or your business, by having a corporation in place, it kind of provides some protection for you personally. Obviously, if you're personally negligent and someone sues you personally, you may still be liable. But generally speaking, if someone sues your business because the business did something, that corporate veil, that corporate wall, if you will, protects you from liability. With a holding company, you can also consider something like an individual pension plan, an IPP. An individual pension plan allows you to set aside money for retirement, allows you to set aside money that you've earned in your company for retirement. And it's a personal pension plan for one individual, or maybe that individual and their family members. Doesn't even have to be a pension plan for all the employees of the company. It can be just you and your family. And this provides your company with a large tax deduction. If it needs deductions, that can be helpful. And there's no tax to pay on these dollars that go into this pension plan until you pull the money out later when you're in retirement. So it's a deferral strategy as well. And sort of similar to an individual pension plan, if you have a corporation, you can consider setting up what's called a retirement compensation arrangement, an RCA. It's kind of like a pension plan where your company contributes to this plan. The company gets a tax deduction for it, and there's really no tax to pay on those dollars inside the RCA until you pull it out later in retirement. So that's all I wanted to talk about related to corporations and kind of deferring tax and why you might establish a corporation. Now I want to share with you an idea that is still available today. Will it be available a year from now? We don't know. I would be probably surprised if it's available certainly a couple of years from now, because it's an idea that just can save a lot of tax dollars for business owners. And it's called a capital gains strip. And just to share with you basically how this works, what this does, it allows you as a business owner to pull money out of your business or out of your corporation at capital gains tax rates, okay, rather than tax rates that apply to salary or dividends. Because in Canada, capital gains tax rates are half of the rates that you'll pay on interest income or salary or what we call regular income. And dividends are taxed sort of in between capital gains and salary, but higher than capital gains. So in Ontario, for example, if you're in the highest tax bracket, you'll pay 26.8% on capital gains, but on salary, you'll pay 53.5%. And on dividends, you'll pay 47.7% on the highest tax dividends. So capital gains, pulling money out of your company as a capital gain can actually work pretty well. It makes sense for larger withdrawals from a corporation as opposed to sort of regular, routine, smaller withdrawals like salary. But if you want to draw a larger amount out, this capital gains strip can really work well. And there's more than one way to do this. I'm going to show you one way to do it. There's more than one way to do it, but you have to speak to your tax advisor about what's the best method to use in your situation. Okay. Now, I don't want to put you to sleep, so I promise I won't spend too much time on this, but I do want to share with you one example of how the capital gains strip can work. So let's pick an individual. Let's call him Jack. So Jack is our individual here, and you can see he owns a company. And let's just say Jack's company is worth $5 million, just to pick a nice round number. So he's got this business that's worth $5 million, but so the shares he owns in his company are worth $5 million. He's paid nothing for these shares. He built the business from scratch. So those shares have what's called a cost base or an ACB of, let's call it 0 or $10, very, very low number. So Jack owns this corporation worth $5 million. He wants to withdraw $1 million from his company. Let's say he wants to do that. How much tax is he going to pay? Well, if he pulls it out as salary, it's going to be $535,000 is the tax liability. If he pulls it out as dividends, it's going to be $477,000. And if he pulls it out as capital gains, he pays just $267,000. So he pays a lot less if he pulls it out as a capital gain. So let's see how he can do that, right? It's easy to pay salary out of a company. It's easy to pay dividends, but taking money out as a capital gain is a little bit more challenging. It's perfectly legal. The government doesn't love it, but they have not shut the idea down yet. So it's still usable. So how does he do this? Well, step number one, Jack's going to take some of these shares. He wants to pull $1 million out of the company. So he's going to take $1 million worth of those shares that he owns in his company, and he's going to exchange them for new shares that are frozen shares, or what we call special shares. These shares are worth $1 million. And in the process of taking $1 million worth of his shares and exchanging them for these new shares, he's going to voluntarily trigger a capital gain in the process. He can choose to trigger the gain that's attached to those shares today. Okay. So what it would look like then is this: Jack would end up with two types of shares. The ones on the right are his common shares. They're worth $4 million now. Remember, his company was worth $5 million. He's got common shares worth $4 million. Now he's got these other special shares that are worth $1 million. Okay, so the total value of his company hasn't changed. It's still worth $5 million. It's just that he's split his shares into two pieces, some that are worth $1 million and some that are worth $4 million. Those shares that are worth $1 million, because we are triggering a capital gain when we do this split of the shares here, he's going to pay some tax of $267,000 when he does this. Now, we're not done yet. Step number 2, what's going to happen? He's going to then take those special shares, the ones that are worth $1 million, he's going to sell them to a new holding company that he sets up, or maybe it's an existing holding company that he already has. He's going to sell them for their value of $1 million. Now, there's no tax to pay in this case because the shares have a cost of $1 million. So in the last step, when Jack, split his shares into two parts, 1 million and 4 million, those shares that are worth $1 million, he triggered a capital gain on those. He paid tax on those shares. So the cost amount for those shares now is now higher. It's $1 million cost amount. All right. So now when he sells these shares to a new holding company, there's no tax to pay. And the holding company actually owes Jack money now. The holding company bought these shares from Jack. The holding company owes Jack $1 million. So you can see from this picture, you can see on the left-hand side, you see the red lines. You can see that the holding company owns the $1 million worth of shares now in his operating company. Jack is owed $1 million from his holding company. That's reflected by way of a promissory note. It's an IOU, right? The company owes that money to Jack. And that finishes step 2. So step 1 was Jack split his shares into two pieces. Then step 2 is he sold the $1 million piece of the shares over to a new holding company and triggered a capital gain tax bill at that time. Step 3, the shares that are owned by that holding company now, the $1 million worth of shares, they're going to be cashed in now. They're going to be redeemed for their value of $1 million. And how does that happen? Well, the operating company is going to take $1 million of cash that it has, and it's going to redeem or cash in those shares that the holding company owns. Now, what happens from a tax point of view when that takes place? Zero, nothing. Okay, that's considered to be a dividend from the operating company up to the holding company on the left-hand side. It's considered to be a dividend, but it's a tax-free intercompany dividend. In Canada, a company can pay a dividend up to its parent company, and there's generally no tax to pay on that. So that dividend will be tax-free in most cases. So what you end up with is this now. You end up with $1 million worth of cash in that holding company. Okay. So the operating company reclaimed its shares, bought its shares back from the holding company, paid the holding company $1 million in cash, no tax to pay so far in this whole picture, except back in step 1 when Jack triggered that capital gain. Now, the last step, here comes the last step here. Step 4, the holding company will then pay off that note that's owing to Jack. And there's no tax to pay when it does that. It's a tax-free payment. So the end result here is that Jack ends up with $1 million of cash in his pocket. He has paid taxes of $267,000 on the capital gain way back in step 1, and there's been no tax paid in all the rest of the steps in the process. So he's effectively extracted $1 million of cash from his company at capital gains rates. Okay. So that's what we call a capital gains strip. I will say this, the government knows about it. They're not thrilled with the idea, but they've not shut it down for various reasons. We thought they might shut it down in the federal budget that just came about back on April 7th, but they didn't. So I would encourage you, if you are a business owner and you have a corporation and you have some excess cash in your company, or you're profitable, is to maybe talk to your tax specialist or accountant about a capital gains strip idea, because the idea probably won't be around a couple of years from now. That's my guess. Okay. Is everyone still wide awake? Maybe what we'll do, I'm going to take a poll here. I just want to ask a question. We've got a couple of polls we're going to take throughout this presentation. The first question I'd like to ask has to do with your status as a business owner. Are you a business owner, or are you an employee, or neither a business owner or employee, or maybe you're not sure what category you fall into? So if you see the poll on your screen, just click on an answer there, whichever answer you think is most suits you, and just click submit. And Sonia, I don't know if we can see the response, the answers to this, can we see the
Yeah,
answers?
I'm just getting them in, so just a moment.
Okay, we'll kind of see how many people are employees, because we're going to talk about employees now, but I want to sort of see how many people are employees versus business owners versus neither, versus maybe you have no idea.
Okay.
And you don't know if you're an employee or a business owner, you're not quite sure what you are. Maybe you need some counseling or something. I don't know. I'm just kidding. I'm just kidding.
Okay,
All right.
okay, I'm gonna end the poll. Here we go.
Okay, we've got a lot of business owners. We got a few employees. Very good. And some
And
people
we
have the category they're in.
Yeah, so we'll send counseling. We'll arrange counseling.
We'll arrange for some personal counseling for those people. Thanks, Sonia.
Thank you.
Let's talk about some employees now. There are lots of ideas that can apply to employees. And I want to talk about two things in particular today, because these things are relevant to most of us today. One are home office expenses. I want to talk about those for a minute. Because we've all been, not all of us, but many of us have been working from home for some period of time over the last couple of years because of the pandemic. So in Canada, who can claim home office expenses? Employees can, commissioned employees can, and self-employed individuals can as well. The reason the government breaks the people down to these three categories is because each of these groups can claim a different kinds of expenses. So that's important to understand. Now, what's the criteria? What allows you to claim home office expenses? Well, first of all, I'll tell you the general rule, and then I'll tell you the special rules that apply to this year, last year, and 2020. There are some special rules that apply to that pandemic period. But normally, the rules work this way, that to claim home office expenses, your home must be your principal place of work, which means more than half your time you need to be working from home. Or if you don't meet that test, there's a second test, which if you meet it, you can also claim expenses. And that is this: your home office must be used solely for work and used on a regular and continuous basis for meeting customers or clients. Most people don't meet that second criteria very easily, but if you meet either of these criteria, then you can claim home office expenses. Now, for 2020, 2021, and this year, 2022, the rules are a little more flexible because a lot of people have been working home during the pandemic. So during the pandemic, here's what the criteria looks like. You can claim home office expenses either the normal way, if you qualify under the normal rules, or you can claim what's called a simplified flat rate amount if you meet a reduced or different kind of criteria. So here's that criteria. If sometime during 2020 or 2021 or 2022, you worked from home more than half the time, just for a period of at least 4 weeks, 4 consecutive weeks in the year. So you didn't have to work from home half the time for the entire year. Even if there was a 4-week period in any of those years where you work from home half the time during that 4 weeks, then you can claim home office expenses. But it also has to be true that you're only claiming home office expenses and no other employment expenses, okay? And your employer cannot have reimbursed you at all for your home office expenses. So if you meet these tests, then you can claim what's called the simplified tax deduction for home office expenses. Let me talk about that for a minute. So in other words, employees have 2 options for claiming home office expenses. You have what's called option number 1, the flat rate or simple method, or option 2, which is the detailed normal method. Okay, the flat rate method, what that says is this, is that, if you meet that test where you work from home half the time for 4 weeks in a row, sometime in the last 2.5 years, 3 years, you can claim $2 per day. Don't get too excited about that. I know it's not a big number, but you can claim $2 per day that you work from home to a maximum of $500 for the year 2021. For the year 2020, it was $400 maximum. Okay. And there's no proof of expenses. You don't have to provide any proof, nothing required there. You can just make the claim. So that's a very simple way to do it. It's called the flat rate method. Now, for some of you who may qualify under the usual rules, because you actually do work from home half the time, you may be entitled to the detailed method, which allows you quite often a larger deduction. Although I will say this, not everyone will get a larger deduction from the detailed method. You could spend all this time doing the detailed method and not be able to deduct $500. So you need to kind of, and generally speaking, if you are a homeowner, it's going to be up in the air whether or not you're going to be able to actually, do better with the detailed method than the flat rate method. Okay. People who are renters are almost for sure going to be able to do better with the detailed method because you can claim a portion of your rent, right? Whereas you own your own home, you can't claim any of your mortgage interest unless you're self-employed. Okay. So, and we'll get into that in just a second. So in the case of a detailed method, there's no $2 per day. You actually add up all your home office expenses, which includes utilities and a bunch of other things, and then take a portion of all those costs. And that portion is, a percentage of your home that's used for business purposes or work purposes. And that percentage is calculated based on square feet. If your office is 200 square feet and your house is 2,000 square feet, then that's 10% of your all those costs would be deductible. Just looking at the kinds of expenses we're talking about here, what can be deducted? So for your average employee, if you're doing the detailed method, you can claim a portion of rent, heat, hydro, repairs, landscaping, supplies, which can be printer ink, paper, those kind of things. Even cell phone airtime can be considered supplies if you're not reimbursed for those things. Now, if you're a commissioned employee, you could add property taxes and insurance to that list of expenses. Okay, but you can't claim property taxes or insurance if you're just a regular employee that's not a commissioned employee. Now, you don't earn commissions. If you're self-employed, you have your own business, you could add mortgage interest and depreciation on your home to that list of expenses if you want. Although claiming depreciation or what's called capital cost allowance, CCA, is usually a very bad idea because if you do that, you will jeopardize your ability to sell your home tax-free later. So it's not worth claiming CCA if you can avoid that. Next steps here, just make sure that your employer signs a special form saying, yes, you're an employee and yes, you work from home. It's called a T2200 form. You don't have to send it in with your tax return, but you have to keep it in case the Canada Revenue Agency, CRA, asks you for it later. And start tracking your home office costs if you meet the tests to claim them, especially if it's the detailed method, you want to be able to claim those. Okay. Last idea I should want to share with employees are non-taxable benefits. Back at the beginning of the presentation, I talked about the 5 pillars of tax planning, and one of the pillars, the last one, was number 5, was called dodging. And that was structuring your affairs so that some of the income or benefits you receive are not taxable. They don't have to be reported on your tax return. And these are exactly some of those ideas that I'm going to share with you now. These are ideas that apply to employees. So employers can compensate employees in ways that may cost the employee no tax. That's the dodging part of it. Okay. So consider the following types of benefits that an employer can provide. If you are a business owner, you might want to think about providing some of these things to some of your employees as sort of a perk or a compensation plan. There's a lot of business owners today. If you're a business owner, you're realizing how hard it is to find good people and to keep good people. There's been a lot of people changing careers, changing jobs in the last couple of years, and that continues. You've probably heard of something called the Great Resignation. That is an ongoing issue in Canada and other parts of the world where people are making career changes. They're resigning to take new jobs other places. If you want to be able to compete with other businesses, you may want to think about offering employees some of these non-taxable benefits. So things like a loan from the employer. So as an employer, if you lend money to an employee, either to buy a car or to help them buy a house, even if it's a small amount, that loan is not considered to be a taxable benefit in any way, as long as you're charging the prescribed rate of interest under our tax law. The prescribed rate of interest today is 1%. So that's a pretty low rate of interest, and it's tough for an employee to borrow money at that kind of a rate anywhere else. So if you happen to be able to lend money to an employee, or even a special employee, a particular key employee, you can do that using this benefit. Assets of personal value. What if as an employer, you go and you buy your employee a desk to use at home, or a computer or a printer to use at home? These can be assets of the company, assets of your business, but you're storing them or allowing your employee to use them at their home. After a couple of years, when they've depreciated in value a little bit, maybe they're not worth as much anymore, maybe they're worth very little after a couple of years, you can sell those assets to your employee at the depreciated value, at a very low cost, $100 or something like that, right? How much is a computer worth after 2 or 3 years? But it still may have value for the employee. So you're buying an asset that your employee is using. It's your asset as a business, but you give it or sell it to your employee a couple of years down the road, but they're using it from day one. That's just another idea. Personal counseling. We talked about personal counseling for those who don't know whether they're, employed or self-employed. Well, personal counseling provided by an employer, if an employer pays for personal counseling, whether it's financial counseling or psychological counseling or marriage counseling, that kind of thing is a tax-free benefit to employees. Daycare services. I'm talking about on-site daycare. So if you are, as an employer, if you provide daycare on-site, that's tax-free benefit. Group plan premiums. So if you have a group benefits plan at work that provides your employees with a certain amount of life insurance or medical benefits, those plan premiums that you pay for are not taxable to the employee. Here's an interesting one people never think of. It's a death benefit. I mean, not every employee is going to pass away when they're employed by you, but if an employee does happen to pass away, you can actually pay a death benefit of up to $10,000 to the family. It's kind of like almost like a severance or a permanent retirement allowance when someone passes away, but it's a tax-free benefit. If it's a reward for their past service, it becomes a tax-free benefit to the family. That can be very helpful to a family when the time someone passes away. Commissions on sales. If your business is selling a product if an employee actually buys the product for themselves, their own use, any commissions that they earn on that sale is actually a tax-free benefit to them. Discounts on merchandise, depending what you sell as an employer, discounts on whatever it is also a tax-free benefit to the employees. Membership fees. So gym memberships, golf memberships, social club memberships. These kind of things can be tax-free benefits to your employee, provided that the employer expects to get benefit from this. So if you as an employer are happy to see your employee with that membership because they're going to spend time at the golf club, at the gym, at the social club, whatever it is, and you think that's going to benefit your business, then those membership fees can be a tax-free benefit to your employee. Gifts and awards of up to $500 per year. So you can give an employee a birthday gift, anniversary gift, a Christmas gift, whatever kind of gift you want, or an award, up to $500 every year. Now, it can't be cash. It needs to be a gift of something other than cash to be tax-free. But if it's worth $500 or less, and it's an item of some type, a gift of some type, then you can receive that tax-free. So go out and find a very large trophy or something worth $500 and give it to your best employee for the year, or find something else they might actually enjoy and give it to them. Home office equipment. CRA has said, government has said, since so many people are working from home, you can buy up to $500 worth of equipment for your employee at home, whether it's a printer, a scanner, a shredder, a desk, chair, a new wireless router for home. We did this for our employees in the first year of the pandemic, and that kind of benefit, it's not a corporate asset owned by your company. It's a gift to your employee, and you're buying them something they can use at home. For home office, that's a tax-free benefit to them. Education costs. So get your employee to take a course if they want to upgrade and take their MBA, or they want to do some other course related to work. As long as it has something to do with or some relationship to their job in some way, then the education costs will be a tax-free benefit. Out-of-town trips. In next week, I'm traveling to New York. Our company is receiving an award there. There's an award ceremony, and I'm going to stay for a couple of extra days to see New York with my wife after the award ceremony. My flight is, it's effectively, I have to fly there for the event. So the event is going to be partly a tax-free trip for me because the company's paying for most of the cost, half the cost anyway. And that will be that portion the company's paying for is a tax-free benefit to me. Meal subsidies. This is, if you provide meals at work, if you have a cafeteria or something like that, and you subsidize the food, that can be a tax-free benefit to employees. And we talked about recreation and fitness facilities. We talked about those kind of memberships already. So there you have it. There's some ideas for employees. And if you're an employer, you may want to think about looking at some of these things for some of your employees. How are we all doing? Is everybody still wide awake? I thought I'd just ask that question because someone told me one time, if you took all the people who have ever fallen asleep in a tax seminar, if you laid them end to end, they'd be a lot more comfortable that way. So, but we're not going to stretch you out on the floor, but I will try to keep you awake. All right, we're plowing through this now. We're coming to an end pretty soon. I want to talk about families for a minute. I want to talk about income splitting, or that third pillar of dividing income, sharing income with another family member, even your kids or your spouse, to make sure that the family as a whole pays less tax. So I want to talk about one idea in particular that's very timely, and that's called a loan to your spouse, a prescribed rate loan. So anytime you lend money to a spouse, you have to be aware of something called the attribution rules. The attribution rules in our tax law apply when you give money or lend money to your spouse to invest. And that investment income that's earned by your spouse will be taxed in your hands, not your spouse's hands. So the government doesn't like that kind of tax plan. We just give your spouse money because your spouse will pay less tax on the income. But we can get around the rules by charging interest on that loan to your spouse. Now, what's the rate of interest you need to charge? Currently, it's 1%. Now, this rate changes every quarter of the year. When you set up the loan, though, whatever rate was in effect when you set up the loan, that's the rate that will apply forever, indefinitely, to that particular loan. And currently, that rate is just 1%. Now, that rate will be going up to 2% this year. We just don't know if it's going to happen in July, on July 1st, or October 1st, because it depends on interest rates and how interest rates rise. Interest rates are going up. We know that. So we know the prescribed rate will go up to 2% on either July 1st or October 1st. So if you want to do this, I would encourage you to take advantage of this strategy before July 1st, before the end of June. Okay, I'm going to show you how it actually works. So you have an opportunity now to set up a loan to your spouse before that rate increases and lock in that 1% rate forever. So let me give you an example. Let's take an individual here. Call him Jack. Jack has $100,000 to invest, let's just say. And he's in the highest tax bracket in Ontario. So he's going to pay tax at 53.5% on regular income. Let's say he can earn 6% on his investment portfolio. So on that $100,000, he's going to earn $6,000 this year. Well, how much tax is Jack going to pay on $6,000 of income? Well, at a 53.5% tax rate, he's going to pay taxes of $3,210. Okay. Now, what if instead he takes advantage of this loan idea with his spouse? So here's what he can do. He can lend the $100,000 to his wife. Let's call her Jill, Jack and Jill. So Jill borrows this $100,000 from her husband. She's going to pay, her marginal tax rate is much lower. She only pays tax at 26%. So, half the rate of her husband. Jack's going to charge the prescribed rate of 1% on this loan to Jill, and that rate's locked in forever. So that's a pretty good rate. She's going to earn that same 6% on the portfolio. Now, she's going to pay 1% a year, or $1,000 on that $100,000 loan. She'll pay $1,000 to Jack every year as an interest charge. And she has to pay that by January 31st every year for the prior year's interest charge. Actually, sorry, that should be January 30th, not January 31st. January 30th for the prior year's interest charge. She will get a tax deduction for that amount. Jack will pay taxes on that $1,000 of income. He'll pay taxes this year of $535. Jill, on the other hand, will only pay taxes of $1,300 on the balance of that income, on her net income of $5,000. Now, where does she get an income of $5,000? Well, it's the $6,000 of investment income she earned minus the $1,000 that she paid to her husband, which she can deduct. So she's going to pay $1,300. In total, the two of them as a couple will pay $1,835 in taxes. That's $1,375 less than Jack would have paid on his own. So by taking advantage of this prescribed rate loan, there's some meaningful tax savings to be enjoyed there. So the more you lend your spouse, the more the tax savings are. Okay. I want to talk about another idea for splitting income. We've talked about a loan idea. Now, what if you don't want to make a loan to your spouse? It's too much work. You don't want to set up a promissory note, which is the way you should do it. You don't want to bother charging interest, all of that. Then you can take advantage of what we call second generation income instead. The attribution rules, if I were to give my wife or lend my wife money, will only apply to first generation income. So in other words, take that $100,000 example. That income that's being earned, that's first generation income. It'll be taxable in my hands, not my wife's, if I don't charge that prescribed rate. But what about second generation income? What about the income on the income and the income on the income on the income? That's not subject to the attribution rules. So you can keep all of that second generation income in a separate account and allow it to grow, take on a life of its own, and it's not subject to the attribution rules. So just to give you an example of what that might look like, what if you were to transfer, let's say, $10,000 instead of $100,000? Let's make it $10,000 to your spouse, interest-free. You're not charging any interest on this. So your spouse has $10,000 of assets now. Okay. Now that $10,000, let's assume it earns 7% return. If it earns 7%, that's $700 in year number one. Who's going to pay tax on the $700? Well, you will, not your spouse, because the attribution rules apply. So year number one, you don't save any tax. Now, what about year number two? Well, in year number two, your spouse starts off with a higher number now, $10,700 in your spouse's hands. The income on that in this second year is going to be taxed $700 to you, but the balance of the income will now be taxed in your spouse's hands because it's the income on the income. It's the 7% being earned on that $700 that was earned last year. What about by year number five? By year number five, your spouse, that portfolio in your spouse's name will be worth $13,000. You're still paying tax on the first $700 of income every year. Okay, that's the first generation income on the amount you gave your spouse, but your spouse pays tax on the balance, everything over and above that. In this case, $218 by year five. By year 10, the portfolio is growing and it's getting closer to 50-50 now in terms of who's paying tax on the income being earned. And by year 15, let's suppose at the end of year 15, your spouse takes $10,000 and gives it back to you, pays you back that amount you lent. Your spouse still keeps $15,000, almost $16,000 in this case. And your spouse is now paying taxes. Is now reporting income of $1,100 annually on that separate portfolio that he or she is accumulating on their own now. So that second generation income can work quite well, and just by giving your spouse some money, leaving it there to grow for a few years, and then if you want, you could take back your original amount later, or leave it with your spouse indefinitely. Okay, I want to talk to investors now.
Did you want to do the poll question?
Oh, yes, we do have a poll question. Thanks for reminding me, Sonia. All right, let's take our second poll question. This is just really to make sure you're all still wide awake. Have you already set up a spousal loan in the past? Let's just see if anybody's actually done the spousal loan idea before. So you can just answer the question, yes or no. Have you set one up, or maybe you're not sure? You can also submit that answer. Let's see what our poll says. By the way, that spousal loan idea is a relatively common idea. It's well accepted by CRA, not risky in any way. Can work very well if you have any investments outside of an RSP, outside of a registered pension plan, or outside of any kind of registered account. It could make good sense.
Okay, let's end the poll then.
See what we've got.
100% no.
100% no. Okay, there you go. So there's room for improvement there. Let's talk now to investors, people, some investment ideas for you. I want to share with you an idea that is very easy to implement and can be very powerful. A number of years ago, I had an individual come to me and he had lost a lot of money in a particular stock. His wife, on the other hand, made a lot of money. And he said to me, can we transfer my losses to my wife? And we thought about it. We said, well, there's no obvious way to do it, but we put our thinking caps on. We actually came up with a way to do it. And so for the last, several years, we've been using this idea that allows one spouse to offset losses against another spouse's capital gains. So let me just talk about how that works. It's really quite easy. In this case, take one spouse that has capital losses. Maybe they sold a stock at a loss. And you know what? We're seeing in this particular calendar year, we are seeing a correction in some of the equity markets. So some of you may have losses on stock positions or whatever this year. If you have losses, but you can't use those losses, because to use a loss, you need a gain to offset it against, right? And capital losses in Canada have to be offset against capital gains. If you don't have any capital gains, maybe your spouse does. And maybe that's where this idea comes in. So one spouse has capital losses, but no gains. The other spouse has a capital gain or capital gains, but no losses. We can transfer unrealized losses to a spouse. Now, when I say unrealized, it means they have to be losses on paper. If you've already sold your stock or whatever, or your asset, and you've realized the loss, it may be too late to do this. It's probably still doable if it's been done, if you did that in the last 30 days. But otherwise, it works best when something has not been sold yet. Okay, but there's an unrealized loss. How does that work? Let's walk through an example. Let's take an individual. Let's call her Anne. Anne owns some publicly traded shares, call them public co-shares. And she paid $500,000 for these shares. That's her adjusted cost base, $500,000. But today, the shares are just worth $100,000. So she's lost a lot of money. Her husband, Henry, on the other hand, reported capital gains. It could be this year, it could be in a prior year. Let's say it was last year. And he reported capital gains of $400,000. Wouldn't it be nice if Anne could take her losses and transfer them to her husband? Because then he could, use those losses against his capital gains, either this year or in the prior 3 years. Capital losses can be carried back up to 3 years. This is actually remarkably easy to do. So let me share with you the 3 steps. Step number 1, Anne is going to sell her public co-shares. And that's going to trigger that $400,000 capital loss on the sale. Okay, so she's got a loss now. Now, this isn't helpful because she can't use a loss, right? She has no capital gains to offset them against. So it's not very helpful. So we're not done yet. So in step number 2, Henry, her husband, is going to buy back those public co-shares on the open market. Don't forget, they're worth $100,000. She sells her shares for $100,000. She loses some money when she does that, realizes a loss. Her husband's going to buy back those shares on the open market in his own name. And what's the result of that? Well, if he buys those back within 30 days of her sale, and that 30-day mark is an important time frame. We'll talk about that in a minute. But if he buys back those shares within 30 days of her selling them, in step 1, then some rules kick in. Special rules in the Canadian tax law kick in. Those rules are called the superficial loss rules. In other words, the loss that Anne had gets denied. She can't claim it because her husband, who's affiliated with her, bought back the investment. So you'd think, well, that's not very good. Well, actually, it's not a terrible thing in this example. Why? Because Anne can't use the $400,000 loss anyway. Does it mean the loss disappears forever? No, the loss does not disappear forever. What happens is the loss that got denied to Anne, the $400,000, gets added now to the adjusted cost base of Henry's newly acquired shares. So Henry paid $100,000 for his shares. So you think, well, that's his cost amount, $100,000. No, for tax purposes, it's actually $500,000 because that loss that was denied to Anne gets added back to Henry's cost base. So Henry actually has shares that are worth $100,000, but his cost for tax purposes is $500,000. Now that brings me to step number 3. Henry's going to sell those public company shares for their value of $100,000. He's got a cost base of $500,000, so he triggers a capital loss of $400,000 that he can use. So all this is 3 steps. It's a sale by Anne, a purchase by her husband, a sale by her husband. That's it. No special forms to file with CRA, nothing like that. He can claim the loss. Now, the timing does matter on this. So just to share with you the timing. So on day number one, N is going to sell those shares. Let's call that day one. You have to start a clock ticking on day one. You have to keep your mind, your eyes open to 30 days later, because the 30-day mark is an important day. Now, step number two, when Henry buys back those shares, that has to happen before the 30th day. It could happen on day 29. That's fine, but that transaction has to close before the 30th day. Now, step three, when Henry sells the investment, that has to take place after the 30th day. Okay, so step two, he could buy it back on day 29, sell it on day 31, and the whole thing works. As long as you get the timing right, which is not that hard to do, then that loss gets transferred. Okay, it's capital loss transfer. I want to talk about now another idea. This was introduced in the federal budget on April 7th. It's the first home savings account. I'm not sure how many of you have heard of the first home savings account. We'll do a little poll in a minute, but this is a new strategy that's been introduced by the government. It does not begin until next year. So in 2023, this is an idea that most people should take advantage of. If you're a young person, or you've got any children who are adults, over 18 or older, and they've not owned a home before, they need to have one of these accounts. So let me talk about what they are. So again, this was new in the federal budget back on April 7th, just 3 weeks ago. What this kind of account does, it's kind of like a tax-free savings account. It's kind of like a cross between a tax-free savings account and an RRSP. What it does, it allows a first-time home buyer to save for a home. So who's a first-time home buyer? Well, that's somebody who's never owned a home before, or has at least not owned a home in the 4 years prior to setting up this account, this first home savings account. Now, as I said, this first home savings account, or FHSA as it's called, is a cross between an RSP and a TFSA. Now, what do I mean by that? Well, number one, you get a tax deduction when you make contributions, okay, to the FHSA. So it's similar to an RSP that way, but there's no tax to pay when you make withdrawals for a home purchase. So in that sense, it's kind of like a TFSA. You can pull money out tax-free. Now, how much can you put into these FHSA accounts? You can contribute $8,000. That's the maximum in any given year, up to a maximum of $40,000 in a lifetime. So if you had enough money to do it, you could put $8,000 in every year for 5 years, and there's your $40,000 contribution. Now, the full amount of the contributions plus all the growth inside that plan can be all withdrawn tax-free if you're buying a home. Now, that's all well and good if you buy a home, but what happens if you don't buy a home? Are you penalized? The answer is no. If you don't buy a home, you can transfer the amount in that FHSA to your RSP. Think of this as additional RSP contribution room. It's over and above what you're normally allowed to put into your RSP. So this should be a no-brainer. Everybody who's eligible to set up one of these accounts should be doing that, because as a minimum, it's like extra RSP contribution room. That's the worst case. Now, if you do buy a home, then you're accumulating assets tax-free inside this plan, but you can pull it later to buy a home. The interesting thing is you can also transfer assets from an RSP to an FHSA to make contributions. So if you want $8,000 next year to go into an FHSA, and you don't have $8,000 of cash lying around, you could transfer $8,000 from your RSP into your FHSA. And there's no harm in doing that, right? Because it's actually a smart thing, because now the money can come out of that FHSA tax-free to buy a home. And if you don't buy a home, just transfer it back to your RSP again later, tax-free. So why would you not do this? So it should be a no-brainer. Everybody should be setting up these plans starting next year. I just want to talk briefly about RSPs versus TFSAs, because they are two of the most common plans for savings. And just want to talk about which one makes the most sense when. Some differences between RSPs and TFSAs, for example, the contribution limits are different, right? So for an RSP, you can contribute up to $29,200 for 2022. And for TFSAs, you can contribute up to $6,000. And when you contribute to an RSP, it's deductible for tax purposes, although you pay tax on the money when you pull it out of your RSP later. In the case of a TFSA, you don't get a tax deduction when you put the money in, but you pull it out tax-free later. Now, if you've never made a contribution to a TFSA since 2009 when they were introduced, you may be able to put in as much as $81,000 into a TFSA all at once. And it's worth considering if you haven't set one of these plans up yet. TFSAs also allow re-contributions. So if you pull money out of your TFSA later after putting money in, say you pull $10,000 out because you want to use it for whatever, you are now allowed to re-contribute that $10,000 to your TFSA later, whereas RSPs don't work that way. You put the money into your RSP, get a tax deduction, you pull it out, you're taxed on it when you pull it out, you don't get that contribution back again. A key driver in this decision between RSP, TFSA, which is the best, is this question: what is your tax rate? Or how much income are you earning today versus what you're expecting in retirement? If you're expected to be in a lower tax bracket in retirement, which means you're going to pay less tax in retirement than you are today, then an RSP may make more sense for you. Okay. But if you're expecting to be in a much higher tax bracket when you retire, in other words, your income is going to be higher because you're accumulating savings and whatnot, you actually may be better off choosing a TFSA today. Okay. If your tax rates are going to be identical in retirement and now and today, then these plans are equally beneficial. There's no one is not better than the other, believe it or not. Couple other points to make regarding TFSAs that might lean the pendulum in favor of a TFSA. Younger people with lower incomes, generally speaking, would benefit more from a TFSA than an RSP, because those younger people with low incomes may not get much of a tax break from their RSP deduction they can claim. The higher your income, the more valuable that tax deduction is. So younger people with less income, probably a TFSA makes most sense. Now, if you're a senior individual, you're older, there's no age limit on TFSAs. Okay, an RSP, you can't contribute to an RSP past age, the year you turn 71. So TFSAs don't have that limit on them. Also, what if you're expecting what I call supernormal returns? You're expecting very, very large returns on the investment you're holding. In that case, TFSAs might make more sense because there's no tax on the withdrawals. Whereas you withdraw, those huge returns from an RSP, you're going to pay tax on every dollar you withdraw. What if you don't need the funds in the plan? You're building up money inside this plan, but you don't actually ever really need it. Well, a tax-free savings account may make sense then because you're not actually forced to make withdrawals. Whereas with an RSP, you have to make withdrawals starting at the year you turn 72. Also, TFSA assets can be used as collateral. That's not true with RSPs. RSPs do offer a psychological advantage. You put the money in, there's a tax cost to taking it out. So a lot of people will leave their RSPs untouched because they don't want to have to pay the tax when they pull it out. Whereas with a TFSA, it's very easy to access those dollars because it's tax-free when you pull the money out. Okay. All right, I want to wrap things up
Did you
here.
want to do that poll?
Yes. Thank you, Sonia. We have another poll. Yes, last poll, and then we're going to finish things off, talk about retirees for a second. Okay, here's the poll. Are you a first-time home buyer? Or do you have any adult children or nieces or nephews that would be considered a first-time home buyer? So is there somebody in your life that is a first-time home buyer? Yes, no, or you're not sure? Again, if you're not sure, we will get you counseling. Otherwise, you can answer that question. And let's just see the number of people who have somebody in their life who may benefit from the first home savings account.
Okay, I'm going to close the poll. Here we go.
Yeah, so 3/4 of people have somebody in your life that will benefit from that first home savings account. So a very high proportion of people. Fantastic. Make sure in 2023, when those accounts become open or available, that you set them up right away. Okay, retirees, we're going to finish off by talking about a couple of ideas here for those who are either in retirement or thinking about it or one day will want to retire, which includes a few people, I'm sure. RIFs versus TFSAs. So for those who aren't sure, an RSP is a registered retirement savings plan. It's the primary way most Canadians save for retirement. But once you reach age 72, the year you turn 72, you've got to convert your RSP, or you got to start taking money out of your RSP. How do you do that? Usually by way of a RIF. You convert the RSP to a registered retirement income fund, a RIF, and then you're forced to take money out of that RIF every year. And the amount you take out increases over the years. Now, the interesting thing about RIFs and TFSAs is if your marginal tax rate, the amount of tax you expect to pay at the time you die, is going to be significantly higher than it's going to be today or even in your retirement years, it could actually make sense to withdraw more money earlier from your RIF and then take those dollars, pay tax on them because you have to pay tax when you make the withdrawal from your RIF. Take those dollars and then contribute those dollars to your tax-free savings account. It could actually make sense to do that. And I'm going to share with you an example of that in a second. What it does result in is paying a little more tax today, paying tax today rather than later when you die. But you're paying tax at lower rates today, because if you wait until you pass away and then your RIF becomes taxable in that year, which it will, unless you leave it to a spouse, then you could actually, prepaying tax could actually make sense. It also allows you to maximize the value of your estate. So let me give you an example. Let's take two twins. Let's call them Ned and Jake. Both of these individuals are age 72 years old today. They're 72. They both expect to live to age 90, let's say. Both can earn 5% on their investments annually. Both have a marginal tax rate today of 30%. So that's their tax rate today. And both expect to have a tax rate on death of 45%. It's not uncommon to have a much higher tax rate in your year of death, because don't forget what I said earlier, when you die, you're deemed to have sold everything you own or a lot of what you own. So anything that's gone up in value becomes taxable in that last year of death, unless you leave it to a spouse. But once the second spouse dies, the tax hits, right? So because you have a lot of income being added to your tax return in that final year of your death, your tax rate is probably going to be higher. So this is not unrealistic to assume that in the year of death that Ned and Jake might have a 45% tax rate. Now, let's take a look at Ned. Ned has decided that he's going to withdraw $8,570 every year from his RIF. Now, why is that? Why that amount? Well, he's going to pay tax on the $8,570, but he'll be left with $6,000 after taxes, which is exactly the amount he's allowed to put into his TFSA every year. Okay, so he can contribute that $6,000 each year to the tax-free savings account. So he's pulling the money out of his RIF, paying tax on it. He's left with $6,000 and puts that into his tax-free savings account. Now, at age 90, when he dies, he can expect to have $183,000 in his TFSA at the time of his death at age 90. What happens in the year of death to your TFSA? Because TFSAs are allowed to be tax-free when you pull the money out, in the year of your death, there's no tax to pay in your tax-free savings account. So the after-tax value that goes to his kids is going to be $183,000. Okay, in this example, no tax to pay on the TFSA. Now, what about his twin brother, Jake? Now, Jake has decided not to do this. He's just going to keep his RIF intact, and he's going to keep that $8,570 in his RIF each year. Those dollars in the RIF will be worth $261,000 upon his death. So actually much higher than the TFSA that Ned has. But when Jake dies, that RIF, or when his second spouse dies, his surviving spouse dies, that RIF becomes taxable. And he's going to owe, on that $261,000 RIF, he's going to owe $117,000 in taxes in his year of death. So knock $117,000 right off the top, and he's left with $143,000 after taxes. So that's the value to his estate. So what we've got is a comparison here. Ned, who decided to make the withdrawals from his RIF early and puts that money into his TFSA, versus Jake, who doesn't do that and who has the bigger estate at the end of 18 years when they turn 90. It's actually Ned, because even though he paid tax a little earlier on his RIF withdrawals, he paid tax at a much lower rate. So Ned will end up with $39,000 more in his estate, which is a 27.3% improvement over his twin brother. So just something to think about. Everyone needs to do the math on their own to kind of estimate, is this worthwhile for them? But it could make some sense. Last thing I want to share with you. This works really, really well if you were a business owner. If you're a business owner, by the way, a sidebar note, well, actually I'll come back in a minute to that. But let me just talk about this. This works well if you're a business owner. Why? Because you can control the amount of your own T4 slip, the amount of income you take out of your company every year. And this idea works really well where you can control that kind of income. So let me share with you what we call the seniors over contribution. as I mentioned earlier, you have to wind up your RSP by the end of the year that you reach age 71. So in the first year that you are age 72 or older, you got to start taking money out of your RSP. You can't even have an RSP anymore, right? But what if you expect to have earned income beyond age 71? So earned income gives you the right to contribute to an RSP. But the problem is when you're older than 71, you won't have your own RSP anymore. So what can we do? Well, if you've got earned income or a T4 slip coming from your company beyond age 71, you can take advantage of something called an over contribution to your RSP before you wind up the plan at age 71. So don't forget, by the end of the year you turn 71, your RSP has to be wound up, probably converted to a RIF. But you can make an over contribution to the plan just before you wind it up. Let me give you an example. Let's say we take Wendy. Wendy turned 71 this year, and so she has to wind up her RSP by the end of this year. Now, let's suppose she has earned income this year of $171,000. Just let's suppose it's a T4 slip income in 2022. What does that do for her? Well, it provides her with RSP contribution room for next year, for 2023, of $30,000. That's the most, by the way, that's the most RSP contribution room anyone can have for 2023 next year. The problem, though, is that Wendy won't have an RSP next year because she's 71 this year. But she can still accumulate RSP contribution room. She can still do that. So what Wendy's going to do is she's going to make her 2023 RSP contribution this year in 2022 while she still has an RSP. In other words, she's going to make next year's contribution now, this year. Now, is she allowed to put the money in? Technically, no. It'll be considered an over contribution to her RSP, but it's okay because the penalty pales in comparison to the tax benefits. Let me show you what that math looks like here. So let's say Wendy's already contributed to her RSP this year, and now she's going to over contribute. Okay, if you're going to do this, do it in December, the last month of the year, because she's going to pay a penalty in December for making this excess or over contribution to her RSP of $30,000. Right, her penalty for the month of December will be $300. It's 1% a month. What happens on January 1st next year? Well, a couple things. Number one, her RSP is gone. She doesn't have it any longer. It's been converted to a RIF. But on January 1st, 2023, that over contribution problem disappears because she's now entitled to new RSP contribution room on that date. Even though she has no RSP, she's still entitled to RSP contribution room. So what's going to happen is she's going to deduct in 2023, next year, she's going to deduct that excess contribution she made this year in 2023. She's going to deduct it in 2023. That's going to save her almost $15,000 of taxes. So she's going to pay a $300 penalty for putting her 2023 contribution in a month early. But she's going to save almost $15,000 in taxes in 2023. She's got this bigger amount inside her RIF now. So it's called a seniors over contribution. Works really well when you can control the amount of earned income that you can report on your tax return. I've had clients who have contributed 5 years worth of excess RSP contributions. Somebody has to wind up their RSP this year because they're 71, but they know for the next 5 years they're going to draw money out of their business as T4 salary. And they know that ahead of time. So they actually make 5 years worth of RSP contributions in December this year before they wind up their plan. They're going to pay a bigger penalty, but then over the next 5 years, they get to claim that deduction for the excess contributions for those contributions to the RSP as their RSP contribution opens up over the next 5 years. So that's all I want to share with you today. It's a lot of information over a short period of time. I apologize if we rushed through it, but I'd be glad to take any questions now. And I'm just glad that some of you stayed awake through the process. So thank you.
Maybe Tim, if you could stop the share and let's go to gallery view.
Yeah, let's do that.
Great, thank you so much. Oh, John has his hand up.
Sure.
Would you like to unmute John there?
Got it, I got it. Tim, outstanding presentation. You've just made things so simple, but I'm going to have some words to say after, so I'll save it for that time. Quick question. Yeah. The FCPA, the new first home buyers program, can you do that and the HDP at the same time, the home buyers HBP at the same thing? Think about that.
Yeah, that's a very good question, John. So what John's talking about is, can you use this new wonderful account, the first home savings account, and also use the home buyers plan, which allows you to pull up to $35,000 out of your RSP tax-free to buy a home? The answer is no, you can't use both. You can only use one. And the first home savings account is a much better option. Number one, you could set aside more money and you can pull up more than just 35,000. And under the home buyers plan, you have to repay the money every year over the next 15 years or so. So unless you want to do that, unless you want to put the money back into your RSP, in which case maybe you like the home buyers plan. But I think the first home savings account is going to probably make the home buyers plan probably obsolete for the most part.
Question. What happens if somebody takes out their whole 40,000 to buy a house, the house deal falls through? So now you got this 40,000, do you automatically have to put it into the RSP? Then you put it in the RSP.
Yeah,
in 4 years, can you do another one?
Good question. No, you can only do this once. So the first home savings account can be used one time only in your life. So once you've pulled money out, the account gets closed and you can never use another one. So you don't pull in money out until you know the house is going to close, right? I'm sure if the house didn't close, I guess the government would need to cross that bridge. You'd have to, think about putting the money back in again. But it's a one-time only event. It may not even be enough. I mean, look at the price of homes today, $40,000 plus growth on that. That's going to be helpful for a down payment, but depending where you live, may not actually be enough either.
I have a question here. It says, when does it make sense to set up a family trust?
Good question. So family trusts can be used you have to really identify what's the purpose. Why do you want to set up a family trust? There are different reasons to set up family trusts. The most common reason is for income splitting or dividing income among family members again. That can make sense if you're probably going to end up with values in that trust, probably $1 million or more over time. That could be in the form of private company shares, or it could be in form of just investments you're accumulating over time. If you're doing that, then that income splitting opportunity is pretty meaningful. One thing we still like to do today is have families maybe lend money to their family trust. Remember I talked about that loan to your spouse at 1%? You can make the same kind of loan to a trust. And then the portfolio earns income in that trust. And now the income can be distributed or sprinkled out to any family members who are beneficiaries of that trust, including children, grandchildren, you name it. So that can be a very effective way to use a trust. It's also good for asset protection. If you put money into a family trust, creditors can't generally get at it. So it's very useful that way. You can multiply the lifetime capital gains exemption, which I talked about, where you own private company shares. You want to use the $1 million, it's almost $1 million now, that exemption, the lifetime capital gains exemption. If you want to use the exemption for your children, your spouse, at the same time as your own, owning some private company shares in a family trust can allow you to do that. So income splitting, asset protection, those are the key reasons for setting up a trust.
I have a question from Stan Conda. Stan, if you want to unmute there.
Okay. Great presentation, Tim. Thank you.
Thanks,
Thank you for doing that. Quick question regarding TFSAs and US currency. I know that Canadians can use US currency when investing in a TFSA. Most of my clients don't, but do you have to do a conversion? Like, if $81,500 is that limit, are you supposed to be doing a conversion, or who keeps track of that?
Yeah, the contributions to a TFSA have to be measured in Canadian dollars. If you were to contribute $81,500 to a TFSA in US dollars, that works out to be probably, I don't know what it is, $60,000 or something like that, or 65. You'd have to convert it to Canadian, always in Canadian dollars. So, but once it's inside the plan, I guess as long as the conversion of the US dollars to Canadian, I would probably put the Canadian dollars in first and then convert it to US dollars inside the plan. Or if you're putting US dollars into the plan, just convert it to Canadian on the day you make the contribution, right? Use the exchange rate, the average exchange rate for the day, and make sure it doesn't exceed the 81,000, limit. Does that make sense?
Sort of, yeah. That's why I've always stayed away from it, because
Yeah,
it's
we
a little
have,
gray. It's a little gray.
we have a lot of clients that have US dollars, but we never hold them in TFSAs.
Yeah, okay.
Yeah, we generally don't.
Okay, thank you.
I see that Wayne Stamler has submitted some questions to you directly, Tim.
Sure, let me take a look. Glad to answer any questions. Yeah, does having a home exclude one from setting up an FHSA? Yes, unfortunately it does. I wish we could all do it, but the first home savings account is only for first-time home buyers, which includes people who have never owned a home before, or those who have not owned one in the last 4 years. And then you qualify as a first-time home buyer. Yeah.
Okay.
Thank you.
And then
Question.
I have,
Can I ask a question, Sonia?
yes, please, Stan, go ahead.
Sorry. So if a 25-year-old has bought a condo, let's say 3 years ago with their parents, 50-50, this really precludes them from using that first home buyer plan, correct?
It actually depends, Stan. Under the tax law, interestingly enough, CRA doesn't always care about whose name is on the asset. They care about whose money went into the asset. So now, if you could argue that the parents bought the asset and just put their child's name on it for estate planning convenience, maybe to avoid probate fees or something, you could argue that home was beneficially owned by the parents. It was never beneficially owned by the child, and you'd still get that first-time status. Technically speaking, now, if the child contributed to the purchase of it, then you have an issue. Yeah.
Okay, thank you.
Sure. Any other questions?
Okay, I have here, what's the best way to save for child's or grandchild's education?
Yeah, good question. I think the simplest thing to do, and the first thing I would do, and we've done it, is to use a registered education savings plan, an RESP. I mean, why wouldn't you use it? For every dollar you put in, the government gives you a grant that goes inside the account at the same time. So typically what you would do is that, you would probably contribute, and normally the amount of the grant is 20%, up to a maximum. So normally you'd put in, call it $2,500 a year, get a $500 grant, do that every year for 7 or 8 years. And you can get, or even 14 years, and build up that grant, those grants over time. So if you can get free grant money from the government in the form of a Canada Education Savings Grant, you might as well use an RESP. Having said that, sometimes that won't be enough depending on how late you are in starting to save. And so, you might want to consider the idea of setting aside money in a TFSA even for that purpose, although I like to use the TFSA for other things. I've written articles before on the 5 ways to pay for an education, and I think what everyone needs is a plan, right? And the 5 ways to pay for an education are begging, borrowing, stealing, sweating, and saving. So begging is getting grant money from scholarships and grants. So a student can apply for those if they've been involved with, community things or whatever, or through their employer, their parents' work or something. So that's begging, is getting free money from the government or schools even. Borrowing is taking out student loans. So some of the costs might be paid for through borrowing. Begging, borrowing, stealing, that's when parents take money out of their other assets like RSPs, tax-free savings accounts, to help pay for their kids' education. I generally discourage parents from taking money from their retirement savings, like an RSP, for example, because your retirement's important, and that's something you need to save for. So begging, borrowing, stealing, sweating, the child actually has a job part-time during school, or maybe full-time in the summer, help pay for school. And then saving, that's where parents actually set aside money in RESPs or other non-registered accounts to help pay for that cost. So the idea is to take those ideas and come up with a game plan that maybe include 1 or 2 or 3, even all 5 of those ideas to help pay for an education.
I know we have John's hand up, but I think, a question here that might kind of go in with that. Sebastian, did you want to ask Tim directly, or do you want me to read your question?
Actually, I'll ask. Hey, Tim, how you doing? Good job.
Good.
Sorry for my Raptors voice.
That's great.
So my question is, will this first homeowner's account, can it be self-directed through a bank? And if you invest the money, can it be invested into stocks for growth tax-free in that account?
Yeah, that's a great question. The answer is we haven't received all the details yet on how the plan is going to work, but I can only imagine, to keep things simple, it's going to mirror the tax-free savings accounts and the RSPs. So the answer will be yes, you can set up a self-directed kind of plan where you pick stocks, do whatever you want in terms of investing that money. I don't think there'll be any restrictions there. It'll look a lot like a TFSA.
Perfect.
Yeah.
Thank you.
Okay, John, and then I'm going to wrap the question period, I think.
Okay. So a couple of questions, Tim. The death benefit. Once the individual passes away, who do you actually, from an administrative point of view, issue a check to? And are there any T slips that would be required, do you think?
Normally what we've seen and done in the past is you normally issue the $10,000 to the estate of the individual. And then you'd issue I guess you have to issue probably a T4A, I guess, or some type, but there'd be a non-taxable, I guess, a box there actually, I think there's a box for death benefits.
Yeah.
So it should be non-taxable, but you'd issue it to the estate. Yeah.
Okay. The other question that you'll often get from people too, and for everybody else, I want to set up a corporation and put all my investments in there. What would you say to that person?
I would say if you're just setting up a company for the purpose of trying to save tax on a portfolio, not a good enough idea. The tax savings are nominal, and whether you save any tax at all annually actually depends on the year, because it depends on how tax rates change. So it's not worth it. But there are times when we will recommend people put a portfolio into a corporation if, for example, they're doing it to avoid U.S. estate tax. Because if you have any U.S. stocks at all, now most people aren't subject to the U.S. estate tax because their estates aren't worth $11 million, $12 million, which is the exemption amount today. But that exemption amount will come down. It may only be $3 million 5 years from now. So a corporation protects against U.S. estate tax. Also, if you're going to do an estate freeze where you're going to cap the value of your tax bill at the time you die, you can cap that tax amount today by doing what's called an estate freeze. Doesn't mean you give up control or access to your investments. It just means that the amount that's growing in your name is capped. And to do that, normally you would transfer investments to a corporation. So if you're doing that, it can make sense. But if you're strictly looking, you're not doing the estate freeze and you don't care about U.S. estate tax, I probably would not be setting up a corporation and transferring investments in. It's different if you already have the investments in a company because you're in the money there. That's different. Yeah.
And I think to your point is that tax rates for investment income usually at the highest rate, personal tax rates. The other thing too, and maybe this is a whole different topic, Tim. A lot of people approach me and say, hey, can I put my money, nudge, nudge, wink, wink, in an offshore scenario where I don't have to report it and not pay tax and, lower tax jurisdiction? Just touch on that maybe a little bit. I think that's always a thing with people with money, right?
Yeah, there are people have set up structures where they try to get outside of the Canadian tax net. The Canadian government's been aware of all these ideas for a lot of years, and they've done everything they can to pretty much shut those ideas down. And so the tax laws today are pretty strict around, it's very difficult to avoid. If you're living in Canada, it's very difficult to avoid tax here. Now, you can get really aggressive and set up a structure offshore to try to avoid Canadian tax. The problem with some of those structures is, and this is where things often fall apart, is you often have to give up control over your money. So, as soon as people find out, well, I got to put this money in this trust, in this corporation, but, I can't be a trustee and I technically can't make decisions around my own money. That's when they say, okay, I'm out. So if you're carrying on an active business, that's different, right? You can move active business income to different parts of the world, depending on where you're carrying on business. That's easier, but passive investment income, it's really difficult unless you want to get super aggressive and put your money at, maybe at risk because you're not controlling it anymore. You might be able to do something, but most people aren't doing that today.
Yeah. I mean, you get a person like David Madoff that does it, and then they made off with all of everybody's money on his own. So
yeah.
Big problem that people don't realize. But here in Canada, we're all subject to our worldwide income. So that's the big issue there. But thank you, Tim.
Thanks.
Okay, thank you, John. Let me just come back to this. So I just want to say, you may wish to get more information by contacting Tim at info@ourfamilyoffice.ca or contact us at info@canslow.com.
Glad to answer any questions later. Yeah.
Thank you, Tim. And now I'd like to present Mr. John Doma, our Canadian Slovenian Chamber of Commerce president. John's the owner and managing partner at Bateman McKay, CPA and Business Advisors. He's deeply rooted in the Slovenian community. John's the Honorary Consul General for the Republic of Slovenia in Canada. He was named Director of the Board and Treasurer for UCAN, which is the European Union Chamber of Commerce in Canada. And he's a co-founder and Director of the Canadian Slovenian Canadian Slovenian Scholarship Fund. Welcome, John.
Hey, no, I just want to say on behalf of all of us, a big thank you to Tim. I know as a tax professional, we often get mired in, when we present tax topics, we get too much detail and make it very complex, and we even get tripped up again. The one thing that Tim has many good things, but Tim has a gift of being able to present tax planning in a very simple and easy format. And it's a gift. Not many people can do what Tim does. And, I just want to thank you, Tim, for taking the time. I know that after this presentation, the video presentation will probably be, a big hit with everybody, because I know people are going to say many, many good things about the presentation and your presentation today. I know I picked up a few things, even though I've been around, all too many years. I picked up a few tidbits from you, and I really, really appreciate your time and sharing some of your secrets, in the sauce in the tax world today, because I know that's, you don't have to do that. So I really do appreciate that. I just want to tell everybody as well, Tim was a person involved with Bateman McKay before I was. Before us taking it over, Tim was Bateman McKay, I'd say a principal or partner, Tim. Yeah. And he went on to bigger and better things. But I look forward, Tim, to continue our relationship and your involvement. And, back in the Slovenian community, I think we'll all be better off with your involvement. Thank you very much, Tim.
No, thanks, John, and thanks, Sonia. I'm glad to help.
I'm Simon here with some friends from Slovenia. We're just actually on the road in a car.
Oh, Simon, you're muted.
Simon, you're muted.
I'm here with Sarah and Davor. Do you hear me? Do you hear us?
Yep. Yes.
So we just want to thank you, Tim. We were listening to you on the road, and they found it fascinating. And it was really educational for them to also hear about taxes in Canada. So once they grow in their business and they expand into Canada, this, I think, is going to be a good asset for them, what they heard today. So thank you.
Thank you for listening.
Nice to hear that Slovenians were on board too. So that's great. Thanks. Let me just, okay, Simon's still there. Good. Okay. Now, let me just wrap up here, if I could. So again, thank you. Please note the contact information for Our Family Office Inc. on this slide, and also, of course, it will be on the YouTube. And Tim has actually been kind enough to enable us to share his whole presentation. So participants today will be emailed a PDF form of his presentation. Thank you so very much, Tim. So the Canadian Slovenian Chamber of Commerce invites you to join our network to help support companies and our community to reconnect between Slovenia, the EU, and Canada. Please consider becoming a member. And special thank you to our supporters, John Doma and the Office of Slovenians Abroad. Also, we encourage you to support the Canadian Slovenian radio by listening and or advertising on Saturdays at 8 o'clock Eastern Standard Time on 100.7 FM. Our upcoming Canadian Slovenian Chamber of Commerce Business Insights event will be June 22nd, where we present our associate. Where we present our associate, Dr. Stefan Bogdan Saleh, founder of the Slovenian Global Business Network, and introducing the Slovenian Business Interactive Global Map, which is a very interesting project they've undertaken. So as for today, thank you again for joining us. Hvala and nasvidenje. Thank you. Nasvidenje. Bye. Lahko noč. Good day.
Thank you.
Thanks.